First of all, this is how euro sign looks like. Many might have already known, especially those who are learning regarding currency and always traveling. The euro is the official currency of 19 out of 27 member states of European Union. This group of states is known as the Eurozone or officially the Euro area, and it includes about 340 million citizens as of 2019. Euro is officially adopted on 16 December 1995 in Madrid. It was first introduced to the world financial market as accounting currency on 1st January 1999. The physical euro coins and banknote entered into circulation on 1st January 2002 for the original members, making it as a day-to-day operating currency. On March 2002, it has completely taken over the former currency. Euro was created to promote growth, stability, and economic integration in Europe. Originally, the euro was an overarching currency used for an exchange between countries within the Union. Between December 1999 and December 2002, euro traded below US dollar but has traded near parity or has crossed above the US dollar with its peak US 1.6 on July 2008. On July 2022, both euro and US dollar hit parity for the first time after almost 2 decades due to the 2022 Russian invasion of Ukraine. Euro is managed and administered by ECB, which is European Central Bank, and Eurosystem. Eurosystem participate in printing, minting, and distribute the notes and coins to all the members of states and operate the Eurozone payment system. As of 2013, Euro is the official second largest currency and second most traded currency in the world, only behind United States dollar. As of 2019, with more than 1.3 euro trillion in circulation, the euro has one of the highest combination values of banknotes and coins in circulation in the world. The first advantage is helps in promoting trade. The benefits of euro are mainly about increase in trading. With euro, it is easier to travel as people does not need to exchange money. It also helps in eliminating currency risk from European trade. Europeans also easily log the business with other suppliers within the European Union, which directly makes the price transparent and the competition between firms increase. Secondly, encouraging investment. Euro is also supporting cross-border investment within the Eurozone. Investors using foreign currency face significant that might be leading to an inefficient allocation of capital, and bond risk is greater than stock due to its lower volatility. Most debt instruments price is stable that exchange rate influence return more than interest rate. Thus, foreign currency bonds have a poor risk return profile for most investors. Before the euro, many successful companies has to pay high interest rate due to their weak currency. In a way that is different from the first thing I mentioned, firms in nation that is less efficient has to pay relatively lower interest due to their currency being stable. The main risk of lending across border is currency risk. Lastly, mutual support. Euro should always reach out hand to the countries that adopt it to support them, especially during crisis. The currency of countries with larger economy tends to be more stable as they can spread risk more efficiently. The mutual support in Eurozone was tested in 2020. Initially, the collective action was not enough and many nations closed their border to each other. However, European Central Bank consistently up enough debt in affiliated countries. The first disadvantage is rigid monetary policy. Euro is a single monetary that does not fit local economic conditions. Parts of Euro is prospering, high growth, and low unemployment. Contrast to that, others suffer from prolonged economic downturns and high unemployment. There is a classic Keynesian for this problem which are entirely different. The country with high growth usually have a high interest rate in order to prevent inflation, overheating, and eventual economic crash. And for lower growth countries, they should lower their interest rate to stimulate borrowing. Countries with high unemployment do not have to worry much regarding inflation because they have enough employees to produce more goods. Unfortunately, it is not easy to lower and raise the interest rate in according to the country as they have euro as a single currency. In fact, euro caused precisely the opposite of standard economic policy during European sovereign debt crisis. Investors fear as growth slow and unemployment increase in countries such as Greece and Italy. However, European Central Bank independence meant printing money was not an option, and higher interest rate may increase unemployment and cause deflation in some countries. With what has been said, it is fair to conclude that euro has been greatly contribute to the economic depression in Greece. Next disadvantage is possible bias in favor of Germany. European Exchange Rate Mechanism, which also called ERM under prospective future member of Eurozone, fixed their exchange rates to German mark. Germany has the largest economy in Eurozone and had history of sound monetary policy since World War II.